Good morning. I'm Mehdi Sunderji and welcome to OETV. We are here live with Jeffrey Hughes, founder at Alpha Insights. Jeff, welcome back, sir.
Great to be here, Mehdi, as always.
So not really very much to talk about. There's been no volatility in the market at all. So we could wrap this one up pretty quickly. No, I jest. Obviously we had a bit of red on the tape yesterday. Things are looking a bit more positive. I think S&P futures as we speak are up about 50 basis points. You publish your weekly piece on Sunday night, and we are here Tuesday at 9 a.m. Why don't we dive right in and kick off with your top down?
Absolutely. The S&P 500 definitely topped on August 16th, and last week's price action confirms that. We broke down to close below the 50-day exponential moving average, which was slightly below the level that I had kind of put out there as a confirmation level. In my view, we've begun what will likely turn out to be a third wave at primary degree of trend down. And so that decline could carry the S&P as low as, say, 2750 as soon as late fall. We're targeting a couple of dates, October 25th and November 8th, Election Day, as major cycle turn dates in the work of Paul McCray Montgomery, and we're sticking by that. We've heard a lot of the bull arguments. We don't buy it. We think, earnings continue to look like they are likely to be revised lower substantially, and we think that will be the next shoe to drop. I'm not going to sugarcoat this. We could be in for a pretty decisive decline over the next 6 weeks, and so I would caution investors that if they are trying to position for a bullish recovery pivot, I think that's the absolute wrong place to be. I would be holding maximum cash, and I would be looking at reducing equity exposure, net equity exposure, to the lowest possible degree that your mandate allows. And that's where we stand right now, Mehdi.
Well, you certainly haven't been sugarcoating anything over the last few weeks, so no one would accuse you of that. I've had 2250 thrown at me week after week from you. So we are watching, and things are unfortunately panning out the way you kind of see them happening. So, let's dive into the rest of your deck. Sure. There's been a lot of chatter around crude recently on and off. There's been some volatility, obviously chats with the Saudis to see if there's anything that can be done on production side. Let's have a look at crude at the moment, and where do you see us going?
Yeah, I think the real reality here is that crude has been in a corrective waveform. It's clearly a three-wave decline. We had that initial collapse, a rally back to a lower high, and then kind of the steady, decline that we count 5 waves down to complete wave C of 4, in our opinion. The market has moved up, pretty steadily off of that, July low around $86 a barrel. And I think it's up maybe 13, 14%, if I'm not mistaken, off that low. And so, I think that we're in for a surge in crude oil prices. We've got a couple of fundamental events that are supportive of that. The first one is the fact that, the Biden administration's release of 1 million barrels a day from the SPRs is winding down. They're not actually releasing 1 million barrels a day. They're doing 90 million barrels over, a 3-month period of time, August, September, October, and nobody knows exactly where we are in that release schedule at this point. So, it could be at the front end of October, could be at the back end of October. My suspicion is that the Biden administration is really trying to shore up their numbers, and they're going to do more on the front end than the back end. But at the end of the day, it's coming to a head. And once we stop that release of SPRs, then I think it's going to, put pressure on prices. The other thing that's out there is the simple fact that the Saudis are not playing ball with us. In fact, they'd very much like to have the price of crude stable above $100 a barrel. We're not quite there yet. And there's talk that the Saudis may actually cut production and discuss it at the next meeting. So, we'll find out. But, our view is this. We've seen an interim low at $86 a barrel. We got a positive divergence in momentum that sets up for a very nice rally. We're in early innings of that rally now, and we think that WTI crude could carry as high as $147 a barrel before this leg of the advance reaches ahead.
Great. So now let's have a look at the Fed, right? So obviously Friday's big sell-off attributed to Powell's comments out of Jackson Hole. What do you think the Fed's going to do at this point? Do you think we're going to see a pivot or no pivot, carry on track? How do you see it all panning out?
Yeah, I think the pivot's off the table until further notice. Anybody who didn't really hear that in the speech that Powell gave, I think about an 8-minute speech, must have been asleep. It's very, very clear that they are going to hike for longer than most people expected and by a greater degree than most people expected. In fact, we put up a chart here of the 2-year Treasury yield. This is through Friday's close. And we went out about 337 last week. We're up a little bit more on Monday. And in the insert in the bottom left-hand corner here is taken from the CME Group's FedWatch tool. And that kind of gives a nice depiction of where the street feels the probability is for a 50 or 75 basis point hike. On Sunday night when we put this chart together, it was 61% probability of a 75 basis point hike. Yesterday, that went to about 74.5%. So, more and more people are believing that we're going to see a 75 basis point hike in September. I think it's a given at this point. The 2-year Treasury yield broke out of a 40-year downtrend. It took out its 2018 highs, and it is surging higher. The next level of resistance comes into play at about 375. I think we'll get there. And the Fed basically is a trend follower. They follow the 2-year Treasury yield. Whatever the market tells them to do is what they're going to do. And I think we're going to be looking at 75 basis points in September and then probably a 50 basis point follow-on hike minimum, okay? And if you listen to Neil Kashkari at the Minneapolis Fed, he'll tell you he thinks that Fed funds need to be north of 4%. And I'm not quite sure if he's wrong about that. If we look out to the next levels of resistance in the 2-year Treasury yield history, we could get up to 5-6% before there's any real resistance once we cut through that 375 area. So, my initial target's 375 and then higher if we can get through that.
And some move on the 2-year. 375 to 5 is quite punchy, but we'll keep watching. Jeff, let's talk about technicals here. You're kind of at the point of this bear market rally seems to be over. It's
over. The bear market decline has resumed. We saw a very interesting pattern develop. That is one of an island reversal. That's when you have a gap to the upside and a gap to the downside. And as long as that's not filled, it leaves an island up there. And so that's exactly what we have. And we're counting this. We've annotated it with Elliott wave counts just to kind of show where we are in this progression. And we've gone down to minor degree. So we've got 5 waves down in minor degree to intermediate wave 1. A rally up to the March 29th high was intermediate wave 2. A decline down to the May lows was intermediate wave 4. A rally up to the May highs was intermediate wave 4, and then decline into the June lows was intermediate wave 5, which completed primary wave 1 down. Now we got a large retracement of more than 50% of that decline in an ABC classic zigzag Elliott pattern, and it stopped dead at the 200-day moving average. And then we saw this island reversal. I think wave 2, primary wave 2, terminated on August 16th, and we are in the early innings of primary wave 3 down. The exhaustion of that uptrend is indicated by the momentum chart in the bottom panel of this illustration, and it shows a negative divergence. It shows just how exhausted that advance was, and momentum has utterly collapsed since. So those who are looking for a resurgence to new highs, I think are out to lunch. They're not paying attention to what the market is telling them at this point. I think the breakdown below this 50-day exponential moving average opens up the gate to, a very rapid decline into the fall that could take, 30 percentage points off the S&P 500 in a very short period of time. Again, we're looking for, a late fall bottom around August 25th to November 8th.
And what about the preferred Elliott wave count?
Well, as you know, a couple of weeks back, we kind of shifted to our most bearish perspective here, and that is that we are in not just a cycle wave or a cycle degree top in January of this year, but a super cycle degree top, at least super cycle wave 3. And if that's true, then we're in a super cycle degree corrective waveform right now, which should take on the form of an ABC pattern at super cycle degree, which means that it's going to be very large. And so the initial decline that we're looking for should retrace at least 61.8% of cycle wave 5. That would get us down to S&P 2250. And again, we've put some illustrations here just to kind of show how early in this process we are. We are just at the very precipice of primary wave 3 down, which will likely be, a collapse of sorts before we see any kind of buying reprieve. But ultimately, we think, sometime past year end, maybe in the first quarter, perhaps just the first half of next year, we should see the S&P carry down to as low as 2250. That level, again, coincides with the 618 retracement of cycle wave 5, which is a 13-year advance off the 2009 low. It also coincides with the prior fourth wave extreme low. That was the March 2020 COVID low, and a rising 200-month moving average, which all kind of coalesce right around that S&P 2250 level in our view. So this is the preferred count. And, our make or break here is SPX 4367. But honestly, in thinking about this further, a move above 4326 would actually break this pattern. And so something different than what we've counted out here is probably happening under those circumstances. And so, I think we'll know as long as the S&P stays below 4326, then this is the active Elliott wave count.
And what about on the flip side? Anything to highlight the positive? Oh, there we go, the 4326 level.
Yeah. So, at the end of the day, our alternate count really suggests that if we were to rally above 4326, then we're probably in an earlier stage of the advance. In other words, the January high probably wasn't the end of cycle wave 5 and super cycle wave 3. It might have been just intermediate wave 3, and we're probably in the midst of tracing out some sort of a lateral consolidation pattern, most likely a symmetrical triangle, which is a very common fourth wave pattern, and ultimately that will resolve to new highs. We would suggest around 5,400 could potentially be the ultimate high under this rubric, and that would terminate cycle wave 5 and super cycle wave 3. So it's not so much that the alternate is this great opportunity to see new highs. We don't think we'll see new highs for some time. It could be years, upwards of 2 to 3 years into the future before we see new highs under this view. But my thinking at this point is that this is highly unlikely based on the price action that we've seen in the last week and days, really. And so I would give this a 10% probability, and I'm putting about a 90% probability on our preferred wave count at this point.
And Jeff, obviously a lot of the stuff that's been happening over the last several weeks due to the holiday season, summer, everything, the volumes have been quite sketchy. What are the implications of that on any of this playing out?
Yeah, so we're kind of discussing the internals, I suspect. And so,
yes.
Volume has been light. There's no doubt about it. In the month of August, we've had 3 of the lowest volume days of the year, and a couple of those were last week and the week before. So no doubt about it, the market gets pushed around more when we're dealing in low volume regimes, right? But when I take a look at last week's volume, this is S&P 500 index volume. 98.9% of the volume last week was on the downside. That's unprecedented, really. I mean, that should give you some, pause for concern. The other thing that I would point out is that bread turned negative last week. And in fact, we're looking at the 5-week moving average at the top panel of this chart, and we see a negative divergence. A lower high was put in place as the S&P rallied to its August 16th high, and now we've broken down below chart support and have actually posted a negative 5-week moving average of net advancing issues. And the middle chart actually shows shorter term momentum, and this looks at the 5-week momentum study using the RSI oscillator. We rallied into overbought territory around that mid-August point and have subsequently rolled over and broken back below the median line, which puts us now in a bearish regime for momentum. So, breadth, momentum, and volume are all exceedingly bearish right now. I would say the internals peaked in mid-August and, are likely to remain depressed going forward.
And what about investor sentiment? Last couple of weeks, it felt like there was a bit of an uptick in investor sentiment. I feel like that's gone as well.
Yeah, investor sentiment at this point in the cycle is more coincident rather than leading. And so, with the bear market rally that we experienced off the June 17th low through the August 16th high, we saw a big recovery in net exposure by the name exposure index. So this is an index of professional investors based on a 2-week moving average survey. And pros got down to, I think as low as 20% or so in terms of their equity exposure during the June lows, but that went back to around 71%. We are now at about 55%, down from 64% last week. So, the pros are still kind of neutral. That range between 50 and 100%, captures 88% of the exposures over the last 5 years. And so, we call that, kind of a normalized positioning. And so we don't see anything unusual about professional investors positioning right now. However, if we look at individual investors are a, historically and notoriously bearish cohort. We did see an uptick in the number of survey respondents that fall into the bearish camp. That jumped up to around 42.4%, while bulls dropped to 27.7%. The bull-bear spread actually reversed about 10 points. Had been hovering around 4%. It's now 14.7%. So, we've seen a pretty big rollover in sentiment from back to, hey, we're neutral. We're open-minded to the possibilities of a new bull market, to So it's definitely rolling over, coincident with the market's price action.
Well, seems to tie into volatility as well. Last couple of weeks, we were talking about the volatility of volatility. Now just underlying volatility seems to be rising as well.
Yeah, the VVIX is a great predictor of the VIX. Typically, when we see divergences, either negative or positive, it's indicative of a change in the prevailing trend of the VIX, the volatility index. And what we were discussing really since early August is that the VVIX had been, starting to exude some level of higher volatility. It had kind of diverged positively relative to the VIX as the VIX made its 9th and 10-week red candles to the downside, right? And so, our sense last week and the week before was that, a spike in volatility was imminent. It's just a question of when. And we got it last week. There's no question about it. We took out the 21-day moving average. Volatility now looks poised, in my opinion, to challenge its May, March highs in the mid 30% range. So, our view is really that VIX is going into the mid 30s or higher. Based on what we've seen so far, I think we can, have a fairly high confidence of that occurrence.
Buy the VIX. Let's have a look at some sectors, high level. Any sectors that jump out at you?
Well, tech was the worst performer, discretionary the second worst performer last week. We saw staples and utilities did better, but were also negative. The only sector last week that stood out as a positive was energy. And as you may recall, last week, we circled energy. It was, I think, the second or third best performer last week. It was negative, but it did outperform. And so our sense was that, energy was setting up for a rally and that it shouldn't be written off. And we were correct at this point. And it looks to us like, our views on nat gas and crude oil moving higher are supportive of energy equities. And we think energy equities are poised to continue this advance. So, we would continue to hold long energy positions. We also like defensives, including utility staples, and to a lesser extent, healthcare. We would definitely be underweight tech, discretionary, comm services, where there's really no case to own comm services at this point. And then, industrials and financials also look like underweights to us. Basic materials is kind of in that gray area. There's a couple of plays within basic materials that could be supportive of that sector. It is going to rally with inflation and materials prices. And so, we would keep that more of a neutral right now. But that's pretty much where we stand on sectors.
Well, thank you for that. And that rolls us nicely into our top picks, top trading ideas for the week. Anything long and short that you want to highlight?
Well, as you know, we like to buy relative strength. And there's no stock in our work that shows up better than First Solar right now as a leader in relative strength. First Solar is benefiting from a change in legislation that came through in the recent inflation package that Congress put through and the president signed into law. And that funding is going to be supportive of their business model. We see the stock emerging from a deep cup base. It broke out above $120 a share, went out last night around 124.5. Our target based on this pattern is that the stock has the potential to move up to about $180 a share. If we're wrong, the stock has no business below 111. That's where we'd set our stop loss to budget risk.
180, 111. And what about on the short side?
Well, on the short side, I think the numbers at Nordstrom continue to look poor. And this is a stock that's been in a downtrend for some time now, and it's now rolling over. I think that this stock, after breaking down below 20, could actually be cut in half from that level. We've got a target of $10 a share. And, I think the stock went out just under $18 last night. So that's a pretty good upside if you're short the stock. If you're a long-only investor, you got no business owning Nordstrom. This pattern is excessively bearish. If we're wrong, the stock shouldn't get above $22. Again, that's where we'd set our stop, just a budget risk here.
Yeah, it's a pretty ugly-looking chart there. Jeff, as always, I want to thank you for your time and sharing your thoughts from Alpha Insights. It's always a learning curve.
And always a pleasure from me.
And to the team at Open Exchange, thank you for making this magic happen, especially live today on Tuesday at 9 a.m. So until next week, we look forward to seeing you again then, and good luck investing.